Awesome. So let's start by the most basic question. What is fixed income? And there are a few different ways to, I guess, define it, but the simplest one and maybe the standard definition would just be, let's think about the Bloomberg Aggregate Bond Index. And that is something that has more than a 50-year history of being an index that tries to encompass all the broadest range of publicly traded fixed income instruments that are available to investors across the globe. So as you can see on the diagram on the right, that has three broad categories. The first being government related, out of which the most popular and the ones that and the largest market cap is sovereign bonds, government bonds. So you would have heard of US Treasuries, or in the UK, we call them gilts. And European countries, Asian countries, they all issue government bonds for institutional investors and households and foreign investors to buy. These things, they fund the deficit, but they also create a liquid asset market for people to save in what is meant to be, at least for the most part, a risk-free, non-defaultable asset that investors can hold to earn yield. So the way that works is people buy a bond with a set maturity date, and the bond promises to pay them back the principal at the maturity date and some coupon over the course of the over the course of the period. That tends to be once every 6 months or once a year. But you have other issuers that can be related to the government, whether they are local authorities or sometimes super sovereign, in that they might encompass something like the World Bank or the European Investment Bank, which can also issue these types of bonds, which are generally thought to be pretty safe. Then you have corporates, all different types of corporates, whether it be an Apple or a Microsoft or a bank, also issuing these types of bonds on the bond markets. And then there are also mortgages. In most countries are something that governments want to create liquid markets for people to be able to get lower interest rates on their mortgages. People securitize and package pools of different people's mortgages into asset-backed securities, such that the risk of any one mortgager defaulting is diversified across a pool of different securities. So that's what the Bloomberg Aggregate Bond Index encompasses. But I'd argue that for our purposes, we can even look a bit broader. When you make a deposit at a bank, you're also in some ways getting involved in the fixed income markets, because why are you doing that? As we say, if we define fixed income as a broad set of financial instruments whose primary aim is to provide yield, when you make a deposit for a fixed term at a bank and they say we pay you 4 or 5% interest, you're also a participant in the fixed income market. In the US, there are instruments called money market funds where you can earn a yield without necessarily locking in your money for a fixed period of time. It's something that you can redeem for the face value. If you put in $1, you'll always get $1 back, but each day you might earn a little bit of interest. And that's also, if you're taking in part, if you're buying a money market fund, you're also involved in the fixed income market. The same thing is if you buy a government bill, which can, instead of being a bond that pays a coupon over several years, a bill is a government debt instrument that matures only maybe in 3 or 6 months, and they're for example, a 5% yielding 6-month bill would you'd be able to buy at say 97.5, and it pays you 100, which is effectively 2.5%, half of 5% annually over half the year. We discussed sovereign bonds, which were the government bonds, the first things we discussed. And then as we go through the presentation, we'll also talk about inflation-linked bonds, because one of the key risk factors in fixed income is what happens to your purchasing power. And the key factor for that is inflation. So governments in the 1990s started to issue bonds that were directly linked to the amount of inflation in the economy as measured by the consumer price index, for example. So we're going to discuss all of these different instruments over the course of the presentation. But at this point, if there's any questions, again, feel free to jump in. Otherwise, we can sort of move on to the next slide. So I like to think about sort of why does any of this matter, and for different people, fixed income markets can be interesting for different reasons. But I think the simplest fact that I think is underappreciated is that it is the second largest asset class in the world, behind real estate and ahead of equities. Equities tend to capture people's imaginations a lot more because we're always talking about Apple and Microsoft and AI, and it's all on Bloomberg or CNBC. But it's actually fixed income that is not only a bigger asset class, but also one that forms the backbone of valuing both real estate and equity assets. And how does it do that? Well, I like to think of most assets, and this may diverge a bit from just focusing on fixed income, as effectively encompassing two components. One is, what would someone, when you're sort of trying to value any asset, should I buy it or should I sell it, is at a certain price, what is someone tomorrow going to pay for that asset, or at some point in the future when I want to sell it out, going to pay for that asset? And actually, if I just hold on to it, what sort of cash flows does it pay out? And in a fixed income asset, the cash flows are already known. So it's a simpler asset in that way. But what's not known is, how do I discount future cash flows? Because there is a concept called the time value of money. Money today is, in most cases, and we can discuss the edge cases later on, money today is worth more than money tomorrow. Or, it goes back to a bird in hand is better than two in the bush. And that's the fundamental concept that fixed income markets and the discount curves they produce by people making a call about what yields and what time value of money should be, that's what fixed income markets determine. So if you knew for sure you'd be paid something in the future, how would you value it? Is the key question. That how would you value it today is a key question that fixed income markets are designed to answer. And so if you think about an equity asset or a real estate asset as also an asset that produces cash flows in the future, but this time those cash flows are variable because you don't know what the earnings of a particular company are going to be over the next 5 years, or what the rent from a particular house that you would buy would be over the next few years. Then even though those are variable cash flows, they are cash flows in the future, you still need to discount them. And it is fixed income markets and the yield curve that they produce that is used to effectively value any of those assets. So I'd say even if you're more interested in real estate or in equities, you have to understand fixed income, which is why people say the golden rule of real estate investing is understanding interest rates and the interest rate cycle. So what actually drives interest rates? And this is again where fixed income markets become interesting, not just for the investor, but also for policymakers or any business that is interested in getting a sense of where the economy is going. Because interest rates are the key lever for monetary policymakers to either cool the economy or to accommodate the economy to stimulate growth. So how does it actually do that? Macro 101 class would tell us that it affects people's borrowing and savings decisions, and it also affects the value of assets, as we've just learned, and that has a wealth effect. So as people's assets go up, they can consume more because they feel richer and they are richer. And as the value of assets go down, as interest rates go up, then you have the opposite impact of that. And yields in fixed income markets are also impacted by how expansionary or contractionary fiscal policy can be. Because obviously, if governments are borrowing more, they have to issue more debt. And all else equal, and all else equal is a very important caveat here, the more supply there is of something in a market, the lower the price. And because price and yield are negatively are inversely proportional in fixed income markets, you get higher yields when all else equal, when there's expansionary policy. So fixed income markets are the markets that monetary and fiscal policy makers focus on the most, even as much as on TV, sometimes it may see that people are focused on where the S&P 500 is. Most policymakers, and I've spoken to many over my career, are laser focused on fixed income markets. So that's another reason why we should all look at them as well. And I'd say at the current moment, after years of very low interest rates, it is also an interesting investment opportunity for people looking to build a diversified portfolio with certain amounts of capital that are relatively lower risk or less exposed to the state of the economy, and provide a fixed yield for them to compound their money. And I'd say the other way in which fixed income is particularly interesting and should have a broader appeal than other asset classes is that most people at some point in their lives will be borrowers. Most people at some point in their lives will probably not be equity issuers unless they own a business and raise outside capital for it. But most people will either buy a home and have a mortgage for it, or at some point have something that they really want to consume but isn't quite affordable at the outset, and so will either take out some credit on a credit card or a personal loan. And so you have a very natural entry into, again, the fixed income market, but more on the issuer side, where you'll have an option of, do I fix my mortgage in terms of the interest rate that I pay over a long period of time, or do I get a floating rate mortgage? And that decision is one that can have a profound impact on your finances, but is one that is rarely well understood for people outside the industry. So that's something that we can also discuss. And if anyone has specific questions on how to make that sort of choice, we can discuss that. I'm very conscious that nobody's asking questions. I don't know if that's because what I'm saying makes no sense or because it makes a lot of sense. Okay, I'm going to give that another 10 seconds. Okay, I'm going to assume that I'm doing a good job and that it all makes a lot of sense. So now we get sort of how do we make any of these decisions when it comes to what type of instrument should I invest in for my portfolio? I mean, it's not on the slide, but even thinking about the borrowing side of the equation, how do I decide what type of mortgage I should get, or how do I even look at, it's all well and good to say, oh, it's a key signaler for the state of the economy or the future path of policy, but how do I actually read the fixed income markets to get a sense of those things? And I'm going to break it down into sort of four broad factors. The first is very related to this concept of duration and a yield curve. And we can just think of that as whether you're a borrower or a lender or an investor, what is the maturity date of the contract? And have you fixed the interest rate, or is the interest rate going to be variable based on where the central bank is going to set rates over the next few years? And that effectively tells you what duration exposure you have. And we will discuss that concept in the next slide. And the other factor, and I think that's the most important question and most important concept for people to master. And then we will spend some time on currency and inflation risk, as well as credit default, and some of these second order factors, which can get quite technical. So we'll maybe leave that to the end.
Does everybody understand what Naman means by duration, and what exactly interest rate risk would be? Liwen, Anna, do you guys get it? Not to pick on you, but
we're going to discuss it in detail now. In any case, and so I'll first draw your attention to the chart on the right, which basically shows this relationship that I was talking about before, which was that as yields rise, prices fall. As yields fall, prices rise. And the amount that prices move in relation to an increase or a decrease in yields is loosely the basis of the concept of duration. And I think for our purposes for now, we can sort of have that as the placeholder, where, as you see, the longer the tenor of the contract, the more sensitive it is to interest rates. And the reason that is you're getting more interest payments effectively, right? If you were just going to get interest for 1 year, then it sort of only matters once. But if you're going to get it for 2 years, it matters twice for the valuation of the bond. So that's why having an investment that is for 5 years can in some ways be 5 times as risky to the changes in interest rates than something that is than a bond that is expires in 1 year. So you might ask, why would anyone ever buy something that is has a longer tenor or a maturity date that's further out in time? And that's because the risk is in both ways. If yields fall, you actually make more money. But if yields rise, you're at risk of losing money. And yeah.
So can I ask a question? Because I think this is a very interesting point you get to. So when we trade in equities, I mean, essentially what we're doing is we're sort of making a bet on if the company is going to perform better or worse than sort of other market participant thinks. Is this a little bit how we should think about bonds? Like we are making a bet on what the yield curve is going to do. I think the yield curve is going to go down over time or behave in a different way than the market participant does, ergo I make a bet on it. Or could you maybe give some context on what is it that we're sort of betting on in the fixed income market?
That's exactly right. We are betting on where yields are going to go. I think it can depend on what your horizon is. You might say, I want to just buy and hold. I don't really care where yields go. I'm happy with the 5% yield that I've locked in today. And, that sometimes there are investors that are contractually just required to gain a certain rate of return. And if that meets their threshold, they buy the fixed income instrument and they just hope that it doesn't default on them or that the inflation doesn't eat away their purchasing power. But for the most part, most fixed income investors are doing exactly what you said, Jakob. They're betting on where yields are going to go. And I'd say when you're buying an equity for the same reason, even though most of what you are betting on might be the value generation that company and that management does in terms of future earnings, but at least a portion of what you do, especially if you're investing in a broader index, is how is the market going to value those future earnings? And that is, as I mentioned previously, is intimately related to the yield curve as well. Because the discount factor is effectively, in some ways, 1 over 1 plus R, where the R is the yield. So let's actually go and see what the yield curve has done over the last almost 60 years. This is a great sort of visual representation that I find can be very helpful to just see the history. Okay. Can everyone see it?
Yeah, we can see it.
Yep. Okay, great. So you can see that people talk about the 1970s. So sorry, maybe I should just pause here. People talk about the 1970s as being a period of high inflation. So we can see how that actually came about via the yield curve. And it's got a helpful legend on the side that tells you where inflation was effectively in that year. So blue is 1% and then goes all the way to almost 15%, as we will see. So when inflation was low and stable, the yield curve was relatively low and stable, and you can see it's pretty flat. We call the slope of the yield curve, people like to say, is it flat or is it steep? Which means right from the beginning, the 3-month, 1-year, 2-year part of the curve versus where the 10-year part of the curve is, the 20-year, the 30-year part of the curve. If the longer time periods correspond to much higher yields than the shorter time periods, we say the curve is steep. And that means that that tends to signal that markets think that in the future yields will be higher, or they think that the current levels of yields are relatively low. Maybe they are stimulating the economy, and in the future that will mean that yields will have to rise, and that in the opposite case, where the shorter term yields are higher than the longer term yields, that says that, oh, actually yields are very high right now versus what we might expect at some point in the future. Knowing that any forecasts about the future are very hard, people tend to think that the future will be some sort of steady state with some risk premium around it, which we can also discuss. But today's yields are relatively high, and therefore they will have to come down. Maybe the economy is more likely to go into a recession, which is why people say that the shape of the yield curve is a signaler for the future states of the economy, and people are worried about inverted yield curves as a harbinger for recession. So that's really where that comes from.
Naman, could you please elaborate on the point of the risk premium again?
Sorry, could you repeat that, please?
So you made the point about risk premium getting priced in the markets. Could you elaborate a bit on that, please?
Yes. So let's actually look at that right now via how the yield curve looks right in 1971. You can see that inflation has started to go from being the blue to like a lighter blue, which is in the around 4% region. And you can see that the Fed hasn't really done much, where the shorter end of the yield curve is actually still where it was a few months prior. Actually the Fed has been cutting rates from 1970 to 1971 as inflation has been going up, in fact. And that has led to a much steeper yield curve. And so you can see that even though the yield curve starts at 4%, by the time you reach the 5-year point, it's at 6%. That's a relatively steep yield curve. And that is showing that people think that there is a risk that because inflation is relatively high and the Fed has been cutting rates, they'd have to raise rates in the future. So when you are making this decision of how long to keep your fixed in, what tenors to buy or what maturity date bonds to buy in your fixed income portfolio, you know that, well, you're locking your money in for a long period of time. And we're going to discuss this when we get to the point about inflation risk. But one of the biggest worries that you would have as an investor is that I bought something for 100 and maybe I get 100 apples in that. And tomorrow, if the price of an apple doubles, I'll only get 50 apples. And so I'd have lost half my purchasing power in an extreme scenario. That's more likely to happen over a longer period of time. And so you would demand higher yields to lock your money for a longer period of time, which is where this concept of a term premium or a steeper curve comes in. But over the years, we've seen that there is also a flip side to that argument, and that is intimately related to how modern portfolios are constructed between a portion of most portfolios is equities and a portion of most portfolios is bonds, where actually the portion that's equities is larger. And people are generally geared to wanting a good economy. So then this concept came about that actually bonds, because the Fed tends to cut rates to stimulate an economy when any central bank will cut rates into a weakening economy when equity markets, real estate markets, businesses are doing poorly. Bonds are a diversifier. And so if you wanted to hedge against a recession, you would be better off investing in bonds. And actually, because the longer term bonds, as we said previously, are more sensitive to interest rates, they would be an even better hedge to a recession, because as interest rates fall by 1%, say a 10-year bond will move 10%, whereas a 1-year bond will only move 1%. And so people also say there's an argument where the risk premium on yields should be negative, because over a longer period, for longer duration assets, you get more of this recession diversification benefit. So the direction of the term premium or the risk premium is really something that moves around at this point based on whether people are more worried about inflation or they're more worried about recession. And that's another way to think about the steepness of the curve. And we'll see that through the 1970s. As you can see, currently you have in 71, you have a very steep yield curve, partly because, as you can see, Fed has already cut rates. Maybe the economy is already starting to show signs of inflation. And so the yield curve is steep and people are more worried about inflation than recession. But as the Fed hikes rates, you can see that we get to a point where the yield curve is fairly inverted, where it starts at 8% and goes down to about 8.5, maybe even, and goes down to 7.5. And you can see this happening as inflation goes up through the 70s. Again, once the Fed cuts rates, because the economy went into a recession, the yield curve steepens back. Then as inflation really goes out of control, you have rates exorbitantly high and a very inverted yield curve. Again, because people are now, the Fed has done its job in terms of raising rates, and people think that's going to cause a recession. And on the margin, people are more worried about that than further increases in inflation from an already high level. So it's
Naman, can I ask a question?
Yes.
So how do you think about, like, let's say if the Fed being a non-economic actor versus like others that are in the market? So let's say, the governments, they issue debt, they want to raise money to, let's say, build bridges, etc., right? But you have this huge market participant who's not out there to make money. Like in an equity market, let's say Apple needs to raise money to build a new factory to, set up an iPhone. They're going to reach out to investors directly. Whereas in fixed income, there seems to be this fairly large central market participant whose, I guess, objectives are not as clear compared to, like, they're not doing it to kind of make money potentially. So how do you kind of incorporate that into your process of thinking about interest rates going forward?
That's a really good question. I think and this is the job of most fixed income investors, is to read the central bank, whether it's the Fed in the US or the local central bank in sort of whatever market you're focused on. And I'd say central banks historically have probably been very opaque, but they've, over the last, I would say, couple decades, they've tried to be more and more transparent, as there's been calls for more transparency. And I think their goals are, first and foremost, price stability, along with, for the Fed, they've stated their long-run objectives in public, and along with price stability, which they define as low and stable inflation of 2%, averaging over the medium term. People tend to think of that as 3 to 5 years. They have a dual mandate, which is minimizing the shortfalls from maximum employment. So trying to have an economy where everyone who wants a job has a job, and an economy that works for everyone in that way, but where you can really look at the metrics via the unemployment rate, via the number of jobs that the economy is producing every month, via things like job openings and hiring rates, quits rates, as well as the inflation objective. So fixed income investors tend to look at where is the economy versus those factors to get a sense of whether the Fed wants to have an accommodative stance towards the economy or a restrictive stance towards the economy. And then they also tend to tell you, based on their stance, what sort of tools they would apply in different scenarios. And they also have other objectives, which is what maybe makes it not as clean, where in certain scenarios, if the markets are in a tailspin or we're in the midst of a financial stability crisis, they also have the responsibility of maintaining financial stability. And I really think of that as very similar to the concept of price stability, because it's about maintaining trust in the monetary system, that a money-like asset that a bank or a central bank or financial institution issues is still seen as something that people trust will retain its value tomorrow, whether that's via maintaining it has to maintain it via its purchasing power and via confidence that it won't default. So financial stability and price stability in that way are also two sides of a particularly interesting coin for the Fed.
So is
I
it
hope
then
that
more
answers your
along,
question.
is it more along the lines that, okay, so now because you're kind of focused on sort of what the Fed is doing, as opposed to, let's say, the credit worthiness of the country kind of issuing the debt, like, is the fact that the central bank, how they can influence markets, a bigger deal, perhaps over the shorter term, but maybe over the longer term, it's like whether the country is, like, there's some bottom-up analysis perhaps that you can do about the outstanding debt and how much GDP a country has. Are those important factors when considering, let's say,
those are definitely important factors, and it's something we're going to get to in the next slide. And if you don't mind, I can answer it then. But those are definitely important factors. We just have to think about it with a little bit of nuance for different countries, depending on what the structure of their policy making and their financial markets are. Yeah, I think we can quickly just go through the rest of this video. You can see again, there are multiple situations where the yield curve steepens as the Fed cuts rates, and then as they hike rates, it can start to flatten back out. We can actually jump a little bit to maybe 2008, as that's always an interesting moment. So you can see rates were pretty stable at about 4 or 5%. And then as the financial crisis, the initial stages came, the Fed cut rates aggressively, you got a steepening of the yield curve. And then as we were in a balance sheet recession and you had QE, quantitative easing, that I think you were in some ways alluding to, you had very low rates for a long period of time. Almost all the way up till COVID, where again, rates were all the way at the bottom. And then we got this increase in inflation that we'll see now. And so, yeah, that's where we are. I think Sal's already given us the perfect segue to get to this concept. So I think you very rightly make this distinction between privately issued assets versus sovereign issued assets like government bonds, because a government via its central bank can always print the money, which some people say QE is, to finance its debt in a way that that they can avoid default. This is only true if you are in control of your own monetary policy, and that also requires the debt to be in your own currency. So if you are a government that is issuing in a different currency, you obviously don't have that control over the monetary policy. Or as Southern European countries found in the European sovereign debt crisis, if the central bank is unwilling to backstop a particular member state's debt, then it's the same situation where they weren't in sole control, like Greece wasn't in sole control of its monetary policy. And so they weren't able to just print their way out of their debt problems. They actually had to rein in spending. But that sounds, for a country like the US or the UK that borrows in its own currency and has control over its monetary policy, that still sounds too good to be true, in that you can never default and people will always give you money and your central bank can just buy your debt. But again, as we saw in September of last year, there are limits to this. And something that sounds too good to be true generally is too good to be true. But it's, again, a very nuanced point. Policy can be extremely contractionary if people are too worried about deficits and don't take into account the fact that actually when there is low inflation, as there was in the post-financial crisis years, then maybe the right thing for governments would have been to not do austerity, which potentially hampered growth and employment and led to a more sluggish recovery, because people were too worried about the debt, versus now where people the policymakers don't seem to be worried about debts and deficits, but actually this is a time where they should be more worried because inflation and interest rates are a lot higher. So the tripwire, the thing that short circuits the whole perpetual money machine of, if I want to spend more on public services, I can just print money because I'm in control of my own monetary policy, as most governments did during COVID, which in some ways was the right answer to a once in a multi-generation event like that shut down economies. The limiting factor to that type of policy is inflation. And that's what we saw in the Liz Truss episode last year in September, is that the markets and in general the public's inflation expectations and their confidence in the purchasing power of the gilt, if those policies had continued to be enacted, went down. And that's why the currency sold off by 15%. And if you think about globally traded commodities like oil, that effectively means for everyone living in the UK, overnight, if that would have stuck, the price of oil has gone up 15%. And so is £10 still £10, or is it actually £8.50? Became a question that people started to ask themselves and people started to ask in the market. And that effectively acts as the disciplining factor. So this is again how fixed income markets, intimately related with currency markets, act as a policing mechanism to certain government policies. There's a very famous quotation by one of Bill Clinton's advisor, James Carville, that if he were to be reincarnated in a future life, he'd want to come back as the bond market because it is the scariest thing and it can change the course of policy. And this is again something that there are lots of famous stories about how hedge funds like hedge fund managers like George Soros, reportedly broke the Bank of England, which is obviously an over-dramatization, but it was effectively breaking an unsustainable policy. In the same way that last year markets had an ugly reaction to what they deemed as an unsustainable policy. So I think, Sahil, to answer your question, maybe with a summary, it would be that in edge cases when policy is deemed unsustainable, in that it will cause a devaluation of the currency or the purchasing power, because there is no confidence that there is any route for the increase in the deficit or the increase in prices to be stopped by an increase in growth or increase in productivity, and that prices will just spiral because of the lack of confidence from one day to another in the stability of prices. That's when these sorts of questions around deficits and debts tend to matter a lot. That's obviously the edge case. We had a period this summer where it was reported that the US government was running, and we can actually see that towards the end of that video, that starting in July of this year, as people re-rated US growth and saw that in a highly geared and well-functioning, high-growing economy, fast-growing economy, the US government was still running a 6% deficit, which was the largest on record for several decades for a non-recessionary economy. So people wanted to, so people started to think about those sorts of questions and started to build up term premium for the future, where it might be the case where, even though it's not the case today, that in the future, the US government might have a situation like what the UK had in September, where investors would lose confidence in the US government's ability to, or US government bonds' ability to protect their purchasing power. Most people, when they invest in a bond, are looking to get a yield that protects themselves from inflation. That's why you don't put the money under a mattress, because your purchasing power will go down just through the normal rate of inflation. That's why you look for some yield. And you look for yield that is actually in excess of inflation. And that's the concept of a real yield, which is just net of inflation. A nominal yield is just the headline yield that you get. And then if you subtract inflation, you get this concept of a real yield. As I said, in the 1990s, actually around the time that James Carville made that comment about the bond market, there was an innovation, which in some ways has been happening for several years in different ways, where governments, to increase the confidence that people have in lending to them, they try and link the value of the principal that they would pay back to what's seen as to a number that is linked to inflation. So sometimes that can be the price of gold. The Indian government, for example, still issues a gold-backed bond, where instead of, if you lend 100 rupees today, instead of getting 100 rupees in 5 years' time, you get 100 times the price of the change in the price of gold. 1 plus that, right? So if gold has gone up by 20% with respect to rupees, you'll actually get 120 rupees back. That way you've preserved your purchasing power, at least against gold. In the same way, governments start to issue inflation-linked bonds. And the benefit of that is you can look at the real yield that an inflation-linked bond pays versus the nominal yield that a normal bond pays. And that difference is basically known as a break-even inflation rate, which tells you what is the market's future expected inflation. And so, again, if you, something for if people are more interested in doing a bit more research, you can look at how the inflation markets behaved in the UK gilt market in the lead up to that September event. where markets were really starting to initially get worried about higher inflation, but then also started to place a much bigger premium on just being paid back, and also required a higher real yield, as well as a higher nominal yield. And there were many technical factors also in terms of just people who had to sell bonds for sometimes uneconomic reasons, that could contributed to that sort of move. So yeah, I'm really glad you asked that question. Hopefully this goes some way towards answering it, but please let me know if there's something else, more that I can clarify.
All good on my.
Awesome. Well, we've hit the hour mark, so maybe we can sort of, I think this is, the next two slides are, the next slide at least is pretty sort of, it's a lot more intuitive in that people tend to ascribe some risk that when you have a corporate bond, for example, that the company will actually default. And so that's something that, if you're taking, the golden rule in finance tends to be, if you're taking a piece of a certain risk, you should get paid for it. Especially if it's asymmetric, where you're not going to get more money if the company does better in a fixed income instrument, because you've already decided what the principal is. It's going to be a fixed amount, but all that can happen is against you, in that the issuer can default. So the risk is very asymmetric against you. So versus that, you should earn a spread to the risk-free yield that compensates you for the risk that this company might default. And the standard way to think about that is, if you want the expected value to be roughly the same, then the probability, you should at least be paid on $100 the probability of default. So if the probability of default is 1% over a given year, over 1 year, you should at least be paid that 1% extra. Does that make sense?
Yeah, I think that's clear.
And so there are these instruments called credit default swaps that most large issuers bonds will have these instruments that are freely traded, that effectively serve as a gauge of what that probability of default is, because that's effectively what this thing tries to measure. It's a derivative that's tied to that probability of default, and it's something that also rating agencies like Moody's, S&P, Fitch, which are big in the fixed income world, will have as a guide towards how risky this particular issuer is. And that's going to drive how much of a spread there is to the risk-free government bonds yields. Yeah, that's that. I think we can, unless there are burning questions around convexity and second order factors, we can maybe open it up to a broader set of Q&A. And I can have also just put up some resources that, if anyone is interested, they can do more research. And I'm always available via email.
Thanks so much, Naman. Does anybody have any questions?
I do, yeah. Do we expect to see a managed decoupling between the US and China? And would that affect the attractiveness of US bonds? Or could that be replaced by?
Nice to hear from you, Sid.
Thank you.
So I would say that this is a key question in global macro. It's a key question for citizens of both countries and probably all over the world. It's something that has been already relatively volatile this year. I think at the start of the year, we expected a Biden-Xi meeting. And then you had the spy balloon, which rocked relations. And it looked like relations were between the two countries were at a pretty dire place before the last 3 or 4 months, where I think the realization that war is, at least for the time being, in nobody's interest when we have 2 wars already going on, that there's been some amount of reconciliation. But I think what's inescapable is that the U.S. foreign policy establishment has gone down a path of de-risking, especially in national security critical areas of technology, semiconductors, artificial intelligence, and defense. They've gone down the path of, they call it a small yard and a high fence, but the yard keeps getting bigger. And so I think that path seems pretty inevitable, but it's something that both sides have a very strong incentive to manage, at least into the next year or two, where I think Biden is looking to maximize stability into an election where his foreign policy record is already being challenged in the political conversation, and where in China there seems to be a lot of more pressing problems when it comes to the economy. And so I think we have this hopefully extended, but I don't have my hopes up on it, but at least a temporary period of reprieve in terms of avoiding escalating tensions per se. But I think the longer term path is still pretty clear in terms of a de-risking, where it's hard to go back to a Chimerica where China and the US had this extremely productive and symbiotic sort of relationship. So and the latest example of the yard sort of growing is that I think now there's a bit more clarity on more rules coming down the line on capital flows from the US into China and vice versa. So it's a key question, and I think managed decoupling. I mean, there are no phrase is going to be completely accurate, but yeah, managed decoupling, and the softer one of it being managed de-risking, at least, is definitely the base case. But I think maybe I wouldn't call it decoupling for the next 6 months, because there seems to have been at least some engagement.
Thank you. Thank you.
Any other questions?
Hey, I have a quick question. Oh, sorry. Did someone else have a question? I can go after them if needed.
You go first. I'll follow.
Okay, sure. So one question I had was, so with the Fitch's downgrade of the US credit rating in sort of recently, so would you expect to see initial volatility in the bond market, or would it be more of an impact in the long term? Because obviously, the US economy has like a lot of underlying strength there. So would investors sort of, so how much, what was the extent of an impact that the credit rating for such a large economy really be, both in the long term and the short term, or is it entirely dependent?
I think we have two historical examples now. There was the S&P downgrade in 2011, and then the events of this summer. I'd say these are extremely well followed, large, liquid markets, and so while they can be inefficient over a short time frame, most things that are well known tend to be in the price, and we had a large move because of these fears and this increase in term premium, and so that initial impact, I think, is in some ways already behind us, and now the market is more focused on the strength of the economy going into next year. We got a good data point yesterday in terms of continued expansion in the number of jobs, and a generally still, while moderating, but still solid labor market report yesterday. But I think the focus of the key focus of the market is really that question around the strength of the US economy. I think the downgrades, big picture, the US still has a relatively hegemonic position, both in terms of its ability to dollar as the reserve currency, which in my mind is backed by the US's geopolitical position, and which is where Sid's question really comes in into focus in terms of how that evolves with engagement with China and other powers. But for now, you'd say the dollar is still the world's reserve currency, and the US has the world's most powerful military. And so there are few alternatives to US markets, and US government bond markets provide that benchmark for that risk-free benchmark to the rest of financial markets. And I think that place is still there. If I would say these downgrades on the margin may be eroded, but I think it's a pinprick versus how liquid, how deep, and how unique US government bond markets are relative to even their next competitors. It will take still years for an Asian alternative or a sort of decentralized private alternative for people to sort of transact something of so much value on a daily basis in such a liquid manner. And I think that's the underlying strength of treasuries as an asset class and as a trading instrument. I would say one of the things that I do worry about is more the internal politics, and if you get instability in the form of a non-peaceful transfer of power after an election. Not saying that is my base case, but if there are issues like that, I think that can start to get people questioning whether and trying to more directly find an alternative. Ultimately, necessity is the mother of invention, and so things can move pretty quickly if, again, confidence in the US goes down. But I think it would go down for geopolitical and political reasons as much as any sort of rating agency downgrade. And it's after something like that happens 3 or 6 months down the line that you'd get that type of downgrade. As you saw this time, really the jitters into the debt ceiling, which was run right into the 11th hour in a way that seemed more dangerous to investors at the current moment. And ultimately investors got over it because they did the right thing, but that's what prompted, along with overall levels of deficits and debt at these interest rate levels, that's what prompted the downgrade. So I think it's up to US politicians, both on the foreign policy part and sort of domestic, how they manage domestic conflicts. But they're still in a pretty good place because the dollar is still the reserve currency.
Thanks so much for that. When I am cognizant of the time and your time in particular, so I think unless anybody has any burning questions, we can wrap it up here. Anybody have any final burning questions? Okay, so if not, thank you so much, Naman. Again, I know it's a really tough task to cater to an audience where we have both hardcore quant researchers and others whose first introduction to fixed income was today. I'm sure I can speak on behalf of everyone that we learned so much. And having been in the fixed income industry for 4 years, I learned a lot as well. Thanks so much for your time, and thanks everybody who joined from across the world. Please keep in touch with the Female Bond Fellowship by following us on various social media channels and other webinar opportunities as well. Thanks again so much, Naman. It was a pleasure having you on board.
Anytime. Thanks so much, and the questions were great. Yeah, thank you for taking the time.